In the spring of 2019, a tech startup in Austin, Texas, posted the best quarter in its entire 4-year history. Record revenue, record profit. The founder sent a company-wide email with 3 words in the subject line: "We finally made it." 8 weeks later, he couldn't make payroll. His employees didn't get their bonuses. The IRS sent a notice. His 2 biggest investors threatened to walk. And the most terrifying part? The company was still profitable. This isn't a story about a bad business. It's a story about a trap that catches good businesses, the ones that are growing, winning, and doing everything right. Stay till the end. There's one insight buried in this story that most business owners only discover after it's already cost them everything. Ryan Garrett had spent 4 years building something he genuinely believed in. Stackform, a B2B software platform that helped mid-sized logistics companies manage their supply chain workflows, wasn't the sexiest startup in Austin. It didn't have a viral moment. It didn't get written up in TechCrunch during its first year. It just worked. Quietly, reliably, and better than anything else on the market in its niche. Ryan, 38, was methodical. An engineer by training, obsessive about product, decent with people, and, by his own admission, someone who left the money stuff to his CFO, a part-time consultant named Patricia Wells, who came in twice a month, reviewed the books, and kept things tidy. Stackform had 22 employees, a beautiful office on South Congress Avenue, a client roster of 40 companies paying between $2,000 and $8,000 a month in subscription fees. For the first time in 4 years, the numbers looked undeniable. Q1 of 2019 had produced $1.4 million in revenue and $310,000 in net profit. Ryan printed the report and taped it to the wall in his office. He'd earned this moment. The celebration was real. The congratulations were real. But what Ryan didn't fully understand, what nobody had ever sat him down and explained, was that profit and cash are 2 entirely different things, and that sometimes, the more profit you make, the more dangerous your position becomes. Here's what was quietly happening inside Stackform's financials while Ryan was celebrating. Stackform had landed 3 major new enterprise clients in Q1, the deals that drove the record profit numbers. But those clients were on net 60 payment terms, meaning they wouldn't actually pay their invoices for 60 days after the service was delivered. The revenue was booked. The profit was real on paper. The cash? Still sitting in someone else's bank account. Meanwhile, Stackform had done what any growing company does. It invested in growth. Ryan had hired 4 new engineers in January to support the expanded client base. He'd upgraded the office infrastructure. He'd front-loaded marketing to chase the momentum. All legitimate decisions, all strategically sound, all paid for immediately in actual dollars from the actual bank account. So while the profit and loss statement looked like a victory lap, the cash flow statement, which Ryan rarely looked at closely, was telling a very different story. Patricia had flagged it in her February review, quietly, in a footnote. Ryan nodded and moved on to talking about the product roadmap. April arrived, and with it came 3 conversations Ryan hadn't fully prepared for. The first was with his head of HR, Janelle Moss. Janelle walked into his office on a Monday morning with a single sheet of paper, a summary of the Q1 bonus expectations she'd communicated to the team back in January. Ryan had promised performance bonuses if the company hit its profit targets. They'd hit them. Comfortably. The team knew it. They were waiting. Total bonus obligation, $87,000. Ryan pulled up the bank account on his laptop while Janelle sat across from him. The balance was $94,000. He felt something shift in his chest. He told Janelle he'd have an update by end of week. The second conversation came 2 days later, not in person, but in a certified letter from the IRS. Stackform's estimated quarterly tax payment was due. Based on the Q1 profit figures Patricia had filed, the federal income tax obligation came to approximately $74,000. Ryan stared at both numbers. $87,000 in bonuses, $74,000 in taxes, $94,000 in the bank, and still outstanding, $210,000 in unpaid client invoices that legally belonged to Stackform but hadn't actually arrived yet. The third conversation happened that Friday evening, when Ryan got a call from David Park, one of Stackform's 2 angel investors. David had seen the Q1 numbers. He was pleased. In fact, he was so pleased that he reminded Ryan of something written into the original investment agreement, a clause that entitled investors to a dividend distribution if quarterly profit exceeded $250,000. They'd hit $310,000. David wasn't being aggressive. He was just reading the contract Ryan had signed 4 years ago when he desperately needed the funding. The dividend owed $40,000. Ryan sat in his car in the parking garage for 20 minutes after that call. His company had just had its best quarter ever, and he was staring down $201,000 in obligations with $94,000 in the bank. He called Patricia that night at 8 p.m. She picked up on the second ring, almost like she'd been expecting it. "I know why you're calling," she said. "Then why didn't you stop this from happening?" Ryan asked. He wasn't angry. He was genuinely confused. "Ryan, I flagged this in February and January. The cash flow projections were right there in the report." Silence. "I need you to walk me through everything," he said. "All of it. Tonight." And for the next 2 hours, Patricia did something she should have done the very first month she came on board as his CFO. She didn't just show Ryan the profit numbers. She showed him the gap, the dangerous, invisible space between profit and cash. She explained that profit was an accounting concept. It recorded values created. But cash was oxygen. It was what paid the people in the office on Friday. It was what kept the lights on. It was what the IRS, his employees, and his investors needed. Not a number on a spreadsheet, but actual dollars, in the account, available right now. She showed him that his $210,000 in outstanding receivables, real money, money that was genuinely owed to Stackform, was trapped in a 60-day payment cycle. And that cycle had created a gap between his profit reality and his cash reality that was, right now, financially life-threatening. "Your business isn't broken," Patricia said, "but your understanding of how cash moves through it, that's what almost broke you." They worked through the night. Patricia helped Ryan draft a respectful but direct request to his 2 largest enterprise clients for early payment, an arrangement called Accounts Receivable Acceleration, offering a 1.5% early payment discount in exchange for payment within 10 days instead of 60. Both clients agreed within 48 hours. $140,000 landed in Stackform's account by the following Thursday. Ryan paid the bonuses in full, satisfied the tax obligation, honored the investor dividend, and then he spent the next month learning something he should have understood from day one. Not just how to read a profit and loss statement, but how to read a cash flow statement. How to map the timing of money coming in versus money going out. How to identify the claimants who would come knocking the moment success arrived. Because that's the part nobody tells you. Profit attracts obligations, and obligations demand cash, not promises, not projections, not paper gains. Cash. Here's the insight that most business owners only learn the hard way. Profit is a score. Cash is survival. You can be the most profitable company in your city and still run out of money on a Tuesday afternoon. Because 3 different groups have a legal and moral claim to your profit the moment you earn it. Your employees, your government, and your investors. And none of them want to hear that the money is on its way. They want it now. Ryan's mistake wasn't ambition. It wasn't a poor strategy. It wasn't a bad hire or weak product. His mistake was believing that a profitable business is automatically a safe business. It isn't. The businesses that survive long-term aren't just profitable, they're cash-aware. They understand the timing. They plan for the claimants. They treat cash flow not as an afterthought, but as the single most important number in the company. Ryan still runs Stackform today. It's doing well, better than ever actually, but he'll tell you something now that he never would have said in Q1 of 2019. The scariest moment of my business life came right after our best month. And I wasn't scared because something went wrong. I was scared because something went right, and I had no idea what that meant. Key lessons from this story. 1. Profit and cash are not the same thing. Profit is what you earned. Cash is what you have. A business can be highly profitable and completely broke at the same time. Never confuse the two. 2. Success creates claimants, and claimants need cash, not paper profit. The moment your business turns profitable, three groups come forward with legitimate claims. Your employees expect bonuses, the government expects taxes, and investors may expect dividends. All three want actual money, not a great-looking P&L. 3. The timing of money matters as much as the amount. $210,000 owed to you is very different from $210,000 in your account. Cash flow is about when money moves, and getting the timing wrong can bring down an otherwise healthy business. 4. Growth accelerates the gap. The faster you grow, the more you spend up front on people, infrastructure, and operations before the revenue actually arrives. Growth is wonderful, but it burns cash before it generates it. 5. The quiet reports are often the most important ones. Patricia flagged the problem twice. Ryan didn't listen because the headline numbers looked good. In business, the footnotes and the cash flow statement are often where the real story lives. The most dangerous moments in business aren't always the obvious ones. Sometimes the trap is built from success, from winning too fast, too soon, without understanding what that winning actually demands. If you're drawn to stories that reveal the hidden mechanics of how businesses actually work, the psychology, the numbers, the decisions that quietly separate the ones that make it from the ones that don't, this channel is built for exactly that kind of thinking. Subscribe if you want more. New story every week. No noise, just insight.